Hey, what's going on? I'm Ryan Stewman, founder and CEO of Closer Capital, and I've got a question for you. Have you ever sat in an office with a banker or ever actually made a phone call to a banker and they spewed out a bunch of terminology that you had no idea what it meant, but you didn't want them to know you didn't know what it meant? So you just, I always say there's two people that smile really hard in this world: a foreigner that doesn't know what the hell you're saying to them, as well as an entrepreneur that has no idea what the hell the bank's talking about. Well, I'm going to help you understand some of the common terminology that bankers just tend to throw out there. Because listen, I remember the first time I sat in a prominent business person's office and they started talking about EBITDA and lifetime value and LTV. I didn't understand any of this stuff, and I felt like an idiot when I left there. So I know that we can all get that feeling of insecurity from banks. So let me help you, give you a little bit of the slang, the technology, the vernacular, if you will, the vocabulary of the banking industry. So first, let's talk about my favorite is DTI. Okay. This is short for debt to income. Now, what does this mean? This is a ratio percentage that they're looking at. So if you make $10,000 a month and you have $5,000 a month in bills, your debt to income ratio is 50%. Okay. So what debt do they take into consideration to count that against you, right? It's only debt that reports on if you're taking out a mortgage or if you're taking out a personal loan, it's only debt that reports on your credit. So think about it. Your insurance payment doesn't report on your credit, so it's not counted against your debt to income. Your phone bill is not on your credit, so it's not counted against your debt to income. Your electricity bill, your water bill, your gas bill, your grocery bill, these things are not counted or looked at or considered in your debt against income. Now, on the business side of things, it changes a little bit because we have these things called balance sheets. At least those of you that have your shit together, you have balance sheets. So the debt that you may owe a vendor, the debt that you may owe for property or whatever the case may be, that payment and everything is considered overall in the corporate debt to income. So there's two versions: personal debt to income and corporate. Corporate encompasses all debt that applies to that company, right? But again, an electricity bill like mine here in this building is $5,000 a month, but that's not debt because at any moment I could just not pay it and not have electricity, and then we wouldn't be here on this video. So that wouldn't be a good idea, but you get the point, right? So my gas bill is, I'm talking about the natural gas. That's not debt. I don't owe debt to the gas company. I use it, I pay them. I use it, I pay them. If I don't want to pay them anymore, they stop letting me use it. Okay. So we're talking about debt. So what are debt? Debt would be, I have debt on this building that I own. I have debt on one of the cars that I lease. I have debt and my credit cards, right? These are things that they consider debt. Now, if I have an investor that loaned me $1 million to start Closer Capital, which didn't happen, I'm just hypothetically, $1 million to start Closer Capital, then that debt would be my debt to income. All right. So when you're trying to figure out your debt to income, the best thing that you can do is go to creditkarma.com, get your free credit report, see what counts right there, add up all of that debt, then try it against, and then gauge it against your income to figure out what ratio percentage that you actually have there. Okay. The next one is LTV, which is loan to value. Okay. We use this a lot when we are buying a business. We use this a lot when we are buying investment properties. And in the mortgage residential side, which we don't do at Closer Capital, but on the mortgage residential side, they use this a lot as well. This is the loan amount to the value of the house. So this is the percentage. Once again, we're doing a ratio of percentages of the loan amount versus the house. So let's say that you're buying a business and that business is for sale for $100,000. And so the bank comes to you and they say, we will give you an approval for 80% LTV. 80% loan to value. If the business valued and sells at $100,000, they will give you an $80,000 loan. Therefore, you need 20% down. That is what's considered a down payment. You need to make up the other 20%. Now, as you know, and I've showed you in previous videos, we have ways to work with down payment, do bridge loans, down payment assisted, merchant cash advances, lines of credit, all sorts of ways around to that. But you got to understand why they're giving you this loan to value. So what they'll do is they will judge your credit portfolio based on your income, your assets, your cash flow, your credit, all of this stuff. And they say, okay, we will loan you this percentage of the value of the property. You know, in some cases could be 100%. But in most cases, it's around 80%. So next up is appraised value. This is a certified valuation. See, I can say a house is worth $100,000. Zillow can say a house or a business is worth $100,000. But until a professional goes out there, pulls the comparable market sales, does an in-depth 1003 appraisal on either the house or on a business, then we don't have an appraised value. We have an estimated value. Once we've got a licensed appraiser to stamp off on what the value of that business is, that building or that house, whatever it is that we're trying to buy, then we have an appraised value. So let's say that you're going to buy an investment property and the realtor tells you, oh yes, the value of this house is listed at $120,000. Okay. That's listed at $120,000. That doesn't necessarily mean the appraised value is $120,000. The appraised value could be higher than that if you're getting a deal. It could be lower than that if they're trying to rip you off. So the appraised value is all that matters to a lender. So for example, if I'm doing an SBA loan for you, you come to me and you say, hey man, I want to buy this car wash for $5 million. It's a full service car wash. This thing is printing money. They've got 10,000 memberships. I'm going to buy this thing for $5 million, right? Like, and the appraisal comes back and that car wash is worth $4 million. Guess what? You might still be buying it at 5, but now the bank's going to assess their loan to value on the $4 million come from the appraisal. Okay. So the appraisal is all that matters and it's all the bank looks at. And listen, I see this happens, you know, people, they want to overpay for something because they see long-term results or they think, you know, hey, I'm going to buy this business at 5 times EBITDA instead of market at 3 because of XYZ, but the banks really don't care. The banks say, hey, here's the appraised value of it. And if you can create value in it, you can always refinance it, get more money later. But if you're going to have to create that intrinsic value, they're not going to loan you on intrinsic value. They're going to loan you on real time value. So another lending term we hear a lot is underwriting. And most people have no idea what this is. So in any lending team, there are 3 participants. Okay. So you go to apply for a loan and the person that you talk to is your funding specialist or your loan officer, whatever the particular term they go by is. And you think that person's doing everything, but that person is on a 3 team. Now, the team could have multiple people in these departments, but it's a 3-department team. Number 1 is the funding specialist or the loan originator. That's the person that takes the application, builds the relationship, places the borrower into the right product with the right bank to get them the results that they want. The second person in the equation, the second department, is called processing. The processor is the person that collects the bank statements, the tax returns, the LLC documents, puts everything and processes it into a nice readable order to pass it on to the third and final department, which is underwriting. The underwriter is simply an analytical person, is simply an analytical person that looks at all scenarios and makes an assessment based on the risk of the outcome of all of those scenarios. So you might think, but common sense is this, but the underwriter is thinking 10 levels deep and looking at all this stuff, plus past experience of default loans that they've underwritten, plus past experience of good loans that they've underwritten, taking all of that into accountability and then making an offer. The underwriter is the final word. So if your loan officer tells you, I'm approved, hey, you're approved, Here's the question. Your funding specialist says, we got you approved. Here's the question you always have to ask. And you should even ask us this when we tell you you're approved. Is that conditionally approved or underwriting approved? Conditionally approved means you're approved based on satisfying these conditions. Underwriting approved means that lady or that dude that's analytical with the giant brain that doesn't want to do your loan is finding a reason not to do your loan, found a reason to do your loan, and that's as good as it gets. So when you're, and use this in not just when you're borrowing money for business for us, but if you're out house shopping and your loan officer for your mortgage tells you that, hey, I've got you an approval. Is it a conditional approval or an underwriting approval? Because there's a big difference. Just like value versus appraised value. There's a big difference. We want the final certification. Because see, here's what a lot of people do in its business in general is they play the come along game. Hey, I'm going to tell them they're approved so they don't leave me. And then I'm going to tell them that I got their conditions back so that they don't leave me. But I've never put it to the underwriter yet who can kill the whole damn thing because I'm just a loan officer and don't know how any of this shit works. That's how it usually works for people, by the way. So hopefully today, I don't want to overwhelm you with giving you a dictionary and reading out a thesaurus and shit to you, but hopefully today you have an understanding more about some of the major terminology that we use in the lending business. If there is a term that you want to know the answer to or one that you think I missed that people need to know about, leave it in the comments below so that people can read and engage and see, and we can all get an education, not just from the video, but from the comments too. And for that, I thank you in advance. Make sure you subscribe to this channel and you feel free to share these videos with anybody you want that might need a little bit of a financial education that I bring here to this specific channel. Thank you.